I'm Megan Horniman, the Chief Investment Officer for Verdence Capital Advisors. Before we go into our outlook and themes for 2022, as we do every year, we wanted to check the box on the themes that we had for 2021. Our first on the economy was that we would be starting this multi-year acceleration in economic growth. And we saw that start to materialize in 2021. In fact, the U.S. economy is on pace to post its best annual GDP growth since 1984. So we're going to check that box. Our second theme was on the global equity market. We had forecast that policy would be supportive, but that investors need to look beyond the U.S. and technology. We're going to give ourselves half of a check on this one, because while global equities did perform very well in 2021, the U.S. outperformed the international markets. But what happened in the U.S. is we finally started to see that rotation out of that expensive tech into other areas of the U.S. equity market, into the cyclical sectors, and that's what our recommendation was for 2021. So we'll give ourselves half a check for that. Our third theme was in fixed income. We expected muted returns and recommended that investors be conservative. We saw that, especially as growth and inflation started to accelerate, that long-term bonds suffered in 2021. So our recommendation to be conservative and focused on short-term bonds, that did prove correct. So we'll check the box for that. Our last theme was in the alternative space, and we highlighted how valuations were different in the public and the private markets, specifically more attractive in the private markets. We also talked about hedging portfolios against the expectation of volatility. What we did warn was that a 60-40 portfolio was not going to give investors the same type of traditional benefits that we saw in the past. Instead, things like real estate, infrastructure, low volatility hedge funds, these all proved beneficial for investors in 2021. So we'll check that box. For 2022, we have 5 main themes that we're going to watch throughout the year. The first, from an economic standpoint, is that the economic expansion is going to mature, but we're not saying it's going to contract. The global central banks, we're going to see divergence in global central bank policy this year. Within the global equity markets, we still think rotation is the key to finding value in these markets. Fixed income, we think a generation of investors will be in for a curveball this year. And in the alternative space, it's very important investors to acknowledge and embrace that new portfolio diversification, which has alternatives in it and not just a 60-40 split of bonds and equities. As we reflect on 2021 and remember where we were this time last year, we were finally getting COVID vaccines rolled out. Economic growth was rebounding faster than anyone had anticipated. And also consumers had a plethora of savings that they were just waiting to get out and spend. When you look at GDP as a whole, we surpassed the pre-pandemic peak in just 5 quarters in the second quarter of 2021. Typically, it takes at least 8 quarters to see that happen. Economic growth was very solid for the year, but we also started to feel those negative ramifications of some of the actions that were taken during the pandemic for us to avoid global depression. We saw inflation surge at levels we haven't seen since the 1970s. We saw the global supply chain collapse, and we also saw American workers leaving the workforce in droves. So how did all this positive economic data translate into investor returns for the year? And as you can see in this chart, equity investors were rewarded by not only that increase in confidence, but also the excess liquidity that was created by not just the Federal Reserve, but also the federal government. What you can see is the U.S. was the biggest leader from an equity perspective. It did outperform our developed international counterparts, and that's primarily because our economic growth was much faster than around the world. Fixed income, they buckled to that outlook for better economic growth and also the surging inflation that we saw in 2021. The broad bond index actually ended up negative for the year. What was the biggest winner was the commodity market, and that's because of a significant supply-demand imbalance across a variety of commodities as the supply was trying to keep up with that surge we saw in pent-up demand.